Hello guys, it's that Dividend guy here. Today I was just reading articles and I stumbled upon one titled 7 of the Most Common Investing Mistakes, and I kind of just wanted to walk through them with you to see, if I've made any of them, to see if you've made any of them, and comment down below on some of the mistakes maybe you made in your earlier years. I'm only about a year and a couple months into this. I started last year in August, so about a year and 3 months. So I'm pretty new. So it's interesting and very important when you're kind of new to it to be very aware of the headwinds that could go wrong or the mistakes that could be made when it comes to investing. So, successful investors avoid these costly mistakes. Investing is one of the best ways to build long term wealth, which is very true. As you invest over time, you're likely to see solid returns and beat inflation, which that's the overall goal. Like a savings account makes you 1%. If inflation's 2, then you lose money. However, not every investing idea is a good one. And if you aren't paying attention to what you're doing, you could make costly mistakes. So this is talking about like not investing in companies you understand or just investing in one that your friend recommends. Do not do that. Do your own research. You're responsible for all of your losses. Just like don't take my advice. Don't get a licensed professional to help you out when it comes to investing so you can learn more. I just like to help people, and if this video helps me stop making mistakes, that'd be great. So here are some of the most common investing mistakes to avoid. If you already made some of these, it's not too late. Just recognize the mistake and try to improve. So that's another very important point. If you make a mistake, don't get too hung up on it. Like let's say one of your stocks, let's say you randomly say there's a medicine or something that comes out from a stock, and that's all it's known for, or it goes down, something like that. You didn't really invest a lot of time in researching in the stock. Just cut it. If you have a loser, like a really big loser, like negative like 75% or something like that, one that's just like it's not gonna come back, just cut the stock. The longer you hold it, especially if it doesn't pay a dividend, like if the longer you hold it, the more money you lose. So, anyways, let's look and see about what she thinks are some of the biggest investing mistakes. Waiting too long. Oh yeah, guys. So not every investment idea is a good idea. So it's a good idea to avoid these. So it will help you have more success while investing. Waiting too long. Waiting too long to start. So this is true. So if you think about it, if you go to a compound calculator, put $1,000 in, times it by a year versus times 40 years, you're gonna have more money the longer it's in there, right? Makes a lot of sense. But the big thing I constantly hear, whether it's from my family, I've heard it from other people, I've heard it from passersby, just like in the community, is it's too late to start investing. Well, that's not true. So let's say, like, I'm 24, so I'm putting my money in stocks that usually range from 3 to 5%. So, whatever amount of money, $1,000 times 5% is more than just $1,000, right? That's kind of the idea. Or if you have, say you need $2,000 a month to live off of, and you have, $50,000 in your savings account, or whatever it may be. I know a lot of people don't have that, but I'm just saying, like, I know most people contribute to their 401k, but they don't actually self-direct invest. So if you think about it, if you do your 401k, that's great, but I like doing that with on top of doing my own self-directed investing. And the reason is because I'm not 100% dependent on my 401k in retirement then. So, and a lot of people say, "Oh, well, there's no point to start, or I don't know how to do it or whatever." Then just get with a financial advisor and start cuz if you think about it, even like, $50 a month or something like that, just something really small. Even if you're in your 40s or whatever, by the time you're 60, 5 times 2 is 10. So you're gonna have like $10,000 to $20,000 extra set aside for $50 a month. You see what I mean? Just like this small thing. So it's never too late to start. Don't put off investing. There are a number of excuses people use to explain why they haven't yet, ranging from "I don't have enough money," which is not true. You could start with $5. "I don't know what to invest in." You could do an index fund. You could do bonds. It doesn't really matter. Just get with the financial advisor and they can help you with that. The good news is that it's just about anyone can start investing with a small amount of money. Applications and companies that facilitate investing with small amounts are readily available, like Robinhood, M1 Finance, Stash. There's a lot, Acorns. And if you're not sure what to invest in, using an index strategy or starting with a robo advisor can be an easy way to move forward while you learn the ropes. So That's another thing is you can get an advisor, but you can really just go to Vanguard and toss your money into a full stock market index fund and probably be fine over the long term. Like it makes 7% a year, so over the course of history. So, it's not bad. You beat inflation. Not investing enough when you have the resources. Ooh, so once you get into the habit of investing, it's important to also get in the habit of investing more. Let's be honest. If you're investing 200 a month, that's probably not enough to build the retirement portfolio of your dreams. As your resources increase, so should the investing. Use the investment retirement calculator to help better estimate how much you should be setting aside for success in the future. So, here's a big thing. So a lot of people, right? So a lot of people when they get a new job or they get a raise or they get a bonus, that goes to like a savings account or you know what I mean? Like they find things like a new vacation, a new car, or something. They find ways to spend their money. So like let's say I was working at Mickey D's, right, making $10 an hour, and I invested $50 a month. And I come home with like say $500 checks or something like that. Then I get a different job and I'm starting to make 15 an hour. The real way you should be going about that is if you can live off 10 comfortably and not sacrifice your lifestyle, you should be taking you shouldn't be taking any more liberties when you earn 15. So what this is saying is if you make 10 an hour and you invest 50 a month and then you go to 15 and you start making, say $2,000 checks instead of $1,000 checks. So instead of 1,000 a month, you're making two. Well, if you can live off 1,000, that means technically you should be able to invest $1,000, right? So that's what this is saying is don't when you go up in job, everything else doesn't have to follow, right? So live below your means so that you can invest more aggressively. That's really all it is. So don't be stingy on the investing because you got a new job and you're like, I can still do 50. There's nothing wrong with doing 50. But if you can do 100 and get to your retirement goals even faster, like double it or triple it or quadruple it when you get a raise, go for it. Don't move up lifestyle just because you made more money. Right, so that's what that's saying. Don't increase your lifestyle based upon your expenses or your paycheck. Keep them at the same level. Keep your life at the level it was at $10, and then just invest the difference. Paying too much in fees. Here we go. Next, so who not every investment's a good idea, and these will help investors get to success. So paying too much in fees. Fees may not truly make or break your portfolio, but they can erode your real returns. The more you pay in fees, the less you end up with over time. Look at brokerages that charge lower fees. You can also look at low cost index funds. So this is talking about your investing advisor. So if they take say 2 or 3% a year, that doesn't sound like much, but if your average is 7 a year and they take like say 2 or 1 or 2%, then you're only making 6 or 5% a year. And the thing is 1 or 2% over the course of your investing life, say if you're 20 and don't have kids yet and you have 40 years, that's a lot of your money that you're giving them. So there are free trading apps now, so you don't even have to worry about people taking your money for buying and selling. So it used to be, now universally, I believe in the industry, it's different because Robinhood pretty much changed it. But it used to be when you bought a stock, you had to pay for it, or when you sold a stock, you had to pay for it. So like if I buy a stock, say the stock's $50, and they charge you a fee of $2 for the transaction. It's like when you use a different ATM and they try to take like $2 out of your account just for using your money. That's the same thing. It's like if you're using the advisor and you're paying them, they shouldn't get interest on top of that, right? So pay attention to the fees. Like I said, universally now, I'm pretty sure that they're cutting them, like the industry is, because it's kind of changed. It's a lot different than it used to be, and a lot of younger investors are taking advantage of that, which is great. But don't let your fees erode your overall returns. So here we go. Next, what's the next pitfall she's talking about? Buying and selling based on emotion. Okay, so this is fun because this can be good and bad. Okay, so when you buy a stock, you feel happy and then it goes down and you feel bad, right? So let's say you bought, I don't know, Clorox came to my mind, right? So let's say you buy Clorox at 120. That's fine, you bought it. Now it pays a dividend and it's a good company, but let's say instead of 120 it goes down like 119.79 and you're like, "Oh no, I lost 30 cents. Oh no, I need to sell it." Or let's say that there's a press release that says that there was was mold or something in 500,000 packages of Clorox wipes. Like, let's just say there was like asbestos or something, and there's bad news, and your stock goes from 120 down to 10 or 105 even. Let's say you lose $15-20 in a day per share. Are you gonna freak out and sell? That's what a lot of people do. So buying and selling based on emotions. Another common investing mistake is buying and selling based on the emotions you feel. You might be caught up in the excitement of a new investment, like I said with Clorox, right? And be ready to buy because of the hype. So let's say Clorox releases a new product. Let's do the flip side of having an issue with a product. Let's say that they release a brand new product and everybody's buying it, right? And so it goes way up. So let's say instead of 120, it goes up to like 150, and you're like, yes, I got to get in because everybody's in, and you buy at 150. But this can lead you to invest in assets without doing research because you're excited, you have FOMO, you're afraid of losing out on what could be a great investment. And so you buy because of the hype. But then let's say, like I said, they have a bad product. So let's say they have a great product come out, right? But then there's a defect with it and the stock plummets, right? You could end up losing out on a lot of money because you bought it when it was high on good news, and then it dropped and then you sold. Well, then not only did you lose money on the investment, then you lost money on the investment. Plus, in selling the asset, you also have to pay taxes on it. So that's where you can get into a lot of hype or a lot of hurt because hype hurts you. So don't panic buy by buying into hype, and don't panic sell because everyone's selling. See, I go for dividend investing, so when something's high, I don't touch it. Right? I have a lot of dividend kings and aristocrats on my list, and there are very few that I buy. There's some that I would buy regardless. So like Procter and Gamble is one of those that I just buy it because I love Procter and Gamble, right? Or 3M or Johnson and Johnson, these big Johnson and Johnson, these big companies that I just love. So sometimes I'm okay with buying up. But when there's bad news for a dividend investor, I buy it. When a stock's down, I buy. When the stock's high, I don't. So don't buy and sell on hype, or don't buy on hype, don't sell on bad news, because the issue you run into with stocks is just like if you look at Tesla's chart, for example, it's like, oh, Tesla has an issue with the autonomous driving, so it drops down to 260, and then they're like, oh, they have a new Tesla truck and it's up to 420. Like, it's so like you can't live like that. So don't invest, don't buy on the hype, don't sell on the lows, because if you have volatile, even a little volatility is gonna drive you crazy. So anyways, don't buy and sell on hype or on panic. Next, we have, like I said, with the last thing, like with the investment advisors, eating away at your returns, taking a percentage. Frequent trading used to do this, but this one's kind of outdated. So frequent trading, when you bought a stock, they used to take a piece. When they sold a stock, they used to charge you. So like they just, like I said with the ATM thing, like with the advisor, when you go to an ATM, like I live in Iowa, if I go to an ATM in Wisconsin, they take like $2 out, right? $2 out of my account for using my account. So it used to be, a lot of them have gone away with this now. But it used to be when you bought a stock, you were charged something. When you sold a stock, you were charged something, and that ate away at your returns or the money you had available to you in order to buy and sell. Because like a dollar fee or $2 fee or 250 or whatever it is doesn't sound like a lot, but if you're a day trader, or you're trying to buy a lot or sell a lot or whatever, what have you, you end up paying a dollar or 250 5 times a day. You're paying 10 to 12 bucks. And if the stock here's the other thing too. If the stock, let's say the stock's a $15 stock and you pay $2, you're paying a pretty big percentage of what that stock is worth. And then, you have to, if you factor that in, all of the buying, let's say you spend 250 on it or whatever, and you make 100 trades, and you spent $2,500, just to buy or sell the stock. That's not even like, you have to take that into account for your overall returns too, because that's going to eat away at it. So not only can you have like earlier it said, an advisor, frequent trading now, like I said, like with Robinhood and M1 Finance and stuff like that, they've kind of done away with this. Some of them still might do it, but you might want to look out, because the more you trade, the more they take. So be careful with that. Buying what everyone else is. So this is like what it said, buying on emotion, buying on the hype. So like, let's say on the new Tesla Cybertruck, you want to buy it because everyone is buying it. Everyone's buying Tesla. The media is the biggest sham. So it will hype a stock up and make it run up, or it can just degrade it, right? So it could be like Tesla has a new Cybertruck and it's going to go up to $500 a share, and it goes up because it's good news. Investors see that on the news and they're like, oh, Tesla's going to go up, it's going to go up, it's going to go up, so then they buy it, right? Just using Tesla as an example, no, not bashing them or anything. But then let's say they have a defect and they have someone's driving, and it drops. So if everybody's buying it, like if it's in the news all the time, if all they have is great things to say about it, don't buy it, because that means that it's probably overpriced and you're going to get bit. So like that's like a crowd herding type thing. So they're herding investors to buy that stock. And so it runs up, and then once everybody's like, "Oh, maybe the Tesla Cybertruck, let's say the wheel's defective or something," then they all drop out of it. And then the people who buy on that hype when everyone else is buying, when it's on its upside, then they're going to get burned because it's going to drop, right? So don't buy on hype. Buy companies that you research, that you're comfortable holding if the market closed. That's a Warren Buffett quote. But don't buy because everybody else is buying it. And honestly, you're more successful if you do the opposite of that, right? So if you react the opposite way, so like let's say like Tesla went down to 260 because Elon Musk sends a tweet out and it's at 260 a share. That's when you should buy, right? Right. So if the trading average is like $400 to like 250 is the low, like 400 is high, 200 is the low, you can get it to 260. Buy it then. Because the thing is, I just use Tesla as an example because it's always in the news. So like it'll go from Elon Musk says this tweet, like talking like that, and it drops down to like say 260, and then a month later, literally they're like Cybertruck is going to be the best thing ever, like, and it's up to 420. It's like, don't buy it when everybody's happy about Tesla. Buy it when people are crudding all over the stock. They say it's going to go bankrupt. It hasn't had a profitable year in 5 years. When there's bad news, when the media is bashing it, that's when you buy it, right? So don't buy when everyone else is, because that's a great way to get knocked off the hype train. Believing you have to beat the market to be successful. Oh yeah, this one's really good. Okay, so just like with the hype train thing, this has a crowd mentality. You don't have to beat the S&P 500 to be a successful investor. So you don't have to average 7% a year or whatever it is. You're successful if you buy it lower than you sold it for. You're a successful investor. Or if you make $50 in the year or whatever you do in the market, right? You don't have to outperform the market to be a good investor. Right? That's just the end all be all. You don't have to. The only person you have to compete with is yourself. Right? You don't have to beat hedge funds. You don't have to beat other investors. Literally, you're in this to make yourself money. That's all you have to do. So it's not about beating anything. It's not about hitting a benchmark. Maybe you set one, but for yourself, say if I invest $1,000, I want to have 1,200 by the end of the year or something like that. You know what I mean? Like if it's strategic for a goal, that you set for yourself, that's different. But do not base your investment career off of beating the S&P 500, because most people don't do it. Hedge funds don't do it. Companies barely do it. Like, it's very hard. Like, people get paid, literally get paid by millions of people, like, to beat the market, and statistically they just don't. Right? So they average the market, or they barely match the market. So don't think you're a bad investor just because you can't beat the market. And if you do, that's great. Like right now I'm making like a 20% return. That's not normal, but you can do it. But don't base your investing career off of it, because a lot of people, they try it and they're like, I can't beat the S&P 500 and I only made 3% this year. Well, what did you make 3% on, $1,500, and whatever you made $400? That's more than your savings account's doing, right? So like if anything above like, what is it now, 0.2% or something, is a gain. So don't base it off of the S&P 500. Base it upon how much you would have had if you didn't invest, right? So always keep that in mind. So think like, let's say you had $1,000 in your savings account. You're going to make maybe $1,001 in a savings account. Like you don't make anything. But let's say you put it in the S&P 500, or you put it in individual stocks, and you end the year with $1,275. Well, that's $275 more than you would have had in a savings account, right? So don't try to beat the market. Just invest for your future. Try to make the best moves that you can, and don't compare it to anything. Just be happy that you're making money, right? Or that you're taking the steps to build a better financial future for yourself. That's really what it's about. It's not about beating the market. Next. Oh, that's all of them. Okay, so let's go through them real quick again. So waiting too long to start. It's never too late to start investing. If you beat a savings account, then you're winning, and the earlier you start, the better. Not investing when you have enough resources. When you get a pay raise, do not, like, if you go from McDonald's to say a factory and you're making 10 and then you go to 15 or 20 or whatever it is. Don't inflate your lifestyle based upon your income, because then you're never going to get ahead. Live below your means, invest the difference. Paying too much in fees, don't let your financial advisor eat away at your returns, because if they're taking 2% per year, whatever it is, and you make 7, you're only making 5. Next, buying and selling based on emotion. Don't do what the crowd's doing. In fact, do the opposite. So if people are buying it, stay away from it. If people are selling it, buy it up. So don't base upon your trading upon what other people are doing. Don't take stock picks from other people. Nothing like that. Do your own research, make your own decisions, and that's how you become successful. But do not do exactly what the market is doing. Don't follow the herd. Go against it. Frequent trading. This is less needed in today's world, but the more you used to buy and sell, the more they would charge you. It's like using your credit card in a different state, or using your card at a different ATM. They'll try to charge you and take a fee for you doing it, and it eats away at your returns. Not so much now, since they have like Acorn, Stash, Robinhood, M1 Finance. You have options now that isn't an issue. Buying when everyone else is. This is just like trading on emotion. Buying and selling should be done when you want to buy and when you want to sell. Don't let outside influences dictate when you're going to do it, because that's when you lose money. So, like I said with Tesla, if it's at 260 and it's 52-week highs 400, you should probably buy it. If they're crapping all over the stock, that's a good time to buy. When you feel uneasy about buying a stock, like because it's down, but you know it's a good company, it's probably the time to buy it. If it's on 52-week highs and it's blazing, you don't really want to touch it. Believing you have to beat the market to be successful. The only goal you should have as an investor is to make money. That's it. Doesn't matter how much money. Even making $3 or whatever, you know what I mean? Whatever it is, you're going for a certain return. So let's say, you make 6.5%, the market does 7. Who cares? Who freaking cares? It's fine. You made money, right? If you really want to be that big of a critic, compare how much money you made in your savings account. You know what I mean? You're not, the only benchmark you have is beating, is the only person you have to beat is your old self, right? Is the person that didn't invest before. So, or maybe last year. I know, you know what I mean? Like, you'll figure out different goals as you go, but don't compare yourself to the market, because hedge funds don't even beat the market most of the time. Like, rich people that get paid millions don't beat the S&P. So, don't base your whole investing career off of the S&P 500. So anyways, guys, those, according to US News, are the biggest mistakes that investors make. So for 2020, look out for these. So say 2020, these are the most common investing mistakes for beginners. And if you're investing in 2020, watch out for these things, and come back to this video if you need a little nod in the right direction. So thank you guys so much for watching. It's been that Dividend guy here. Remember to hit that subscribe button, and when you do, hit the bell notification so you don't miss any updates on my dividend investing portfolio for Robinhood. I also do like doing these smaller videos and helping out people starting out, because I've only been doing this for about a year and a half, and it is always good to look and research and see what type of mistakes I could be making to avoid them. So not only does it help you guys, but it helps me as well. So thank you guys so much for watching. Like I said, hit the subscribe button, hit the like button, hit the bell notification, and I'll see you guys on Monday with another dividend investing video. Take care.